Markets are finally waking up to something that's been quietly building in the background for months. A rate hike from the RBA in February is no longer a tail risk. It's a live event. Let's start with the December labour market surprise because this was a big one. Markets are positioned for unemployment to rise to 4.4%. Instead, it fell to 4.1%, the lowest level in 7 months. At the same time, employment surged by more than 65,000, reversing last month's decline and then some, with the bulk of the gains coming from full-time employment. Now look at the unemployment rate. When you strip out the month-to-month volatility, the trend is now clearly lower. This isn't a labour market that's loosening. It's tightening once again. The participation rate reinforces that very message. It started to roll over when you look through the monthly noise. That's important because declining participation caps the risk of a sharp rise in unemployment, even if employment growth slows. It means the labour market can stay tighter for longer, and that's exactly what the RBA is worried about. Then there's underemployment, which measures the proportion of the employed workforce who would like to work more hours. It's back to the lowest level since 1991. That's a powerful signal that spare capacity in the labour force is being exhausted rapidly. When underemployment collapses, bargaining power shifts towards workers, and wage pressures typically build, as does consumption risk moving to the upside. Put it all together and the inflation risk becomes obvious. Australia cannot grow quickly right now without generating inflation. Productivity growth remains poor, so stronger employment, rising wages, and resilient consumption feed straight into price pressures. We're already seeing that dynamic show up in recent inflation data. Understandably, markets have reacted swiftly. Swaps pricing now shows a 25 basis point hike from the RBA in February as slightly more likely than not, with a full hike now priced by May. That's a material hawkish repricing in a very short period of time. And remember, even with another cut implied from the current 3.6% cash rate, the RBA's November forecast didn't have underlying inflation returning to the 2.5% midpoint of its target by the end of 2027. Policy was already borderline accommodative relative to the inflation outlook. Yes, there are definitely seasonal distortions in the monthly employment data around summer due to holidays. But when you look at the broader trend in unemployment and participation, it's increasingly hard to argue that this is simply noise. The bond market is backing that view unanimously. 3-year Australian government bond futures hit fresh cycle lows following the data. And when you back out the yield, it's sitting around 4.25%, well above the current level of the cash rate. Essentially, multiple hikes are now priced in. FX markets have certainly noticed too. Aussie US pushed to fresh cycle highs with price action and momentum entirely bullish as rate expectations shift higher. All of this now puts next week's Q4 inflation report front and center. If trimmed mean inflation prints at 0.8% for the quarter, exactly what the RBA forecasts imply, then a strong labour market and consumption data may force the RBA to start hiking rates just months after finishing a 75 basis point easing cycle. That's why next month is no longer hypothetical. It's entirely live.